Here we are again, another Tuesday evening. How is everybody? Nice to see the chat in motion before the show formally starts. We're on pre-show mode just for a little while longer. And we're going to have, I think, a fascinating conversation this evening with Damien. He's teed up ready to come in. The dogs, of course, are here, looking nice and cozy and comfortable, and hopefully will be nice and quiet. Fingers crossed. And, you never know, but bins are collected today, so it always is interesting. For those interested, the main studio is here, and you can see Damien teed up ready to come in there. And we've got everything else working as normal with the various multi-views and the chats and the other slides that we use all set up. So hopefully running pretty well. Fingers crossed, as all of these things, technology, well, it mostly works occasionally. Occasionally it doesn't, but I think we're good, which is excellent. Well, we just hit the 8 p.m. start time, so I'll take the pre-show off. I'm going to start the show properly. We'll be back in just a moment. Well, good evening and welcome to this live stream on the 5th of May 2026. It's Martin North here from Digital Finance Analytics. Great to have you on this evening. Thanks for taking time out of your Tuesday to share it with us. Really appreciate it. And I think this will be an important conversation tonight, given that the RBA lifted as expected, and we've got the Gulf War battling around, and we've got the AI story. So all of those are coming together, and Damien and I will tease some of those things out and pose ourselves a few questions with regard to where do we go from here and what does it mean for investing. Before I get Damien to come in formally, let me just remind you that I'm not going to provide specific financial or legal advice on the channel here. This is a general conversation only. We moderate the chat, but feel free to throw questions, comments, suggestions as we go. If you use that Walk the World DFA, that'll get into my queue. I've also enabled Super Chat, which means you can get your question to the top of the list or indeed make a contribution to what we do around here. Appreciate those who support us via Super Chat, Patreon, or PayPal. Helps to cover the costs. We don't do this for profit. We do this because we think there's a really important conversation to be had, and particularly now. So let me bring Damien straight in. Damien, welcome back. Lovely to see you again.
Good to see you, Martin.
Well, interesting month. I know
Yes.
last time we speculated about is the war going to end quickly or not, and how does that impact the situation? But now we've got the shenanigans going on with various blockages in the straits, attempts to maybe go around some of those blockages. The oil price is still bubbling higher, but markets in the US are hitting all-time highs, driven, of course, by the AI story, with 800 billion, I think, of investment now planned, and the results from a lot of those big companies were actually quite powerful in terms of the cloud revenue that they created. And meantime, in Australia, little Australia, we seem to be caught in a bit of a bow wave, or however you want to describe it. The RBA lifted rates again. The expectation is now for less growth rather than more growth, and higher interest rates probably ahead too, which then begs the question, well, how do you put all this together from an investment perspective? If you're thinking about saving for your retirement, where should you invest? Is the US a better home than Australia? And what are the implications of that? So we're going to explore some of that this evening, and specifically, I think, touch on the RBA as well, because the RBA story is quite important to understand too.
Yeah, absolutely. So I'll give you a quick history because I can never remember what we've done. There's been a lot of movement since over the last couple of months. We try and do as a big picture. We don't try and trade our portfolios much. We try it's very much at the margin is what we generally do with our say our tactical growth portfolio, which is it's all about asset allocation. When are you in stocks? When are you in bonds? When are you in cash? We've done a lot recently. So the outbreak of the war, we went very much into cash very quickly, and started to wind up our exposure to inflation-linked government bonds in particular. And then as the sort of truce deal, or as the original round of fighting sort of stopped, we very actually quickly pivoted and went back and loaded up on equities with a view that, hey, there's this incredible boom going on, And if we end up in this sort of stasis where enough ships get through the Strait of Hormuz that you don't end up with a crash, a world economic crash, there's this crazy earnings growth going on in the background, and you need to have exposure to that. And so now we've sort of been winding that weren't really, it was much easier when the markets were sort of 10, 15% lower, and now they're a bit higher. It's like, okay, so the risks, are they growing? Are they shrinking? We're winding a little bit back at the margin, but yeah, I think we'll go through I think we should go through some of the major risks, I guess, is what we're seeing in terms of how that fits together. And then secondly, let's or maybe firstly, we'll have a look. We'll also have a look at that earnings side of it and really dig into that. What is happening in terms of this earnings growth, and how does it sit versus history, and why why is it so extreme? And where's the money coming from? Where's it going to? Because I think there's a lot within that we need to unpack. But as you said, probably the first place to start is the RBA, given we sort of had some news out of that today. Is that a place to
yeah, I think
off?
it probably is. And it is just worth, for those who may not have caught the RBA decision, they decided to increase the cash rate by 25 basis points to 4.35%. Now, that's significant. 4.35% was the previous peak last time rates went up. So basically, we've gone down and then back up again. And they said that the inflation picked up materially in the second half. Remember, that is before the conflict. So they're saying inflation was already strong. And then, of course, the conflict in the Middle East resulted in higher fuel and related commodity prices. That's already adding to inflation. And therefore, there are cost pressures, maybe increasing the prices of goods and services from companies. Money market rates and government bond yields have risen. Exchange rates appreciated, but credit's still available, they say. Heightening uncertainty. I think uncertainty was mentioned, more than 40 times in the Statement on Monetary Policy, which came out today, which is, I think, something of a record. But they may go on to say higher prices and prolonged uncertainty may cause growth to be lower in Australia, trading partners, and also in Australia. So that was where they started. So the decision was to, jumped back, go there, yeah. Higher fuel prices added to inflation. Inflation likely to remain above target. 8 members voted to increase the cash rate, and 1 member decided to park and stay at 4.1.
Now,
so
was it 4.5 last time or 5.4 last time? I feel like
4.3,
anyway.
4.35.
No, sorry. I'm sorry. There was 8.1. Sorry, it was 8.1 this time.
Yeah. No, it was. It was more. It was more
quite close.
Yeah, it was more close last time. This time,
yeah.
Now there's two I listened to the press conference, and Michelle Bullock made a couple of really interesting points. The first was she was a little bit more critical than previously of government spending and how government spending actually is also potentially inflationary, which is interesting. Yep. The other thing that she said was, just be clear, us living interest rates won't do anything to impact the cost of oil, in the inflationary impulses of that. But it's the second order and the third order effects that they're worrying about. In other words, will firms pass on rate hike, the rate hike cost, the cost of oil, to effectively their goods and services? And will the expectation of higher inflation get embedded? Because if it gets embedded, then it's almost impossible to deal with it. So she was looking for much longer term rather than the short term. They raised 3 scenarios in their Statement on Monetary Policy, which is actually quite interesting. Because the Statement of Monetary Policy, which comes out, every few months, had these 3 scenarios. So in one scenario, the oil price comes up, comes down, but the other is that it goes up a lot higher and stays there for a lot longer. And that means that basically trim mean inflation, unemployment has different outcomes too. But even in the worst case scenario, they're still not looking at massively higher unemployment, and they're looking at a little bit lower growth. So it feels to me as though they're still very much sort of wired to, well, it's not going to be that long, it's going to shake itself out. But just so you've got that data, this is the output, and you can see the changes there in terms of growth and CPI, et cetera, et cetera. Markets are still, of course, looking for more cash rate rises potentially. And of course, they do use that market model as an input to their assumptions. And it's this funny circular argument. So they take the oil price from the market and they take the expectation of the interest rate movements from the market, and we plug them into the model and we come out with what we think is going to happen, which is highly circular in my view. Never really quite understood how that works.
Yeah, I mean, I've certainly got. I mean, I've got sympathy for saying what is the market saying because there's a lot of people and a lot of there's a lot of bright people and a lot of economists out there putting their hard earned dollars on the line to make a bet in a particular direction and say this is what we think is going to happen to the economy over the over what time frame. So I think it's worth having that as an eye to that, but I don't think I don't. You don't want the RBA just to be merely a reflection of what's going on in the market. We're just basically we're looking at the market and pricing it in, and then the market's looking at what we're saying and pricing it in, and you end up either a virtuous or an unvirtuous circle.
Well, it's a feedback loop, isn't it? And that basically you end up everybody believing the same thing. And just one other little cut here. This was quite interesting. They showed the indirect domestic fuel intensity of CPI, and they showed how intense it is in travel, fruit and veg, groceries, new dwellings. All of those are things that, of course, feed directly into ordinary households, whereas perhaps some of the other stuff a little less so. And of course, they also made the correlation between the road freight price and the oil price, and it's strongly up because, of course, the oil price is up. So, yeah, it's not looking good. And I think my sort of general takeout from all of this is they are saying huge amounts of uncertainty exists. What happens in the Middle East, particularly around the Hormuz Straits, is critical. We're running multiple scenarios at the moment, but we need to actually deal with the immediate inflationary pulse. What the Australian government does is actually quite important. And it's fascinating to me that now Chalmers is suggesting, I think, of handing out some money to households in the upcoming budget. And I'm thinking, oh, hang on a moment. Sounds inflationary.
Yeah, going to be happy with that. Well, and we went from the pre-COVID where we had the back in the black, the whole back in the black, and Morrison running this whole thing about, oh, no, we're going to get the budget balanced. Meanwhile, the RBA is like, we can't get demand. We're trying to roll our interest rates to get demand going. You're running exactly the opposite to what they want. And now we've flipped back around and we're like, we're trying to get inflation under control. And we're like, oh, maybe everyone needs a little bit more money. And so, there is definitely, this is the part about having an independent, independent setting of interest rates is that at least when you go, well, the government, if the government's more directly controlling it, they've got both. They can decide: do I want to run this as fiscal? Or do I want to run it as interest rates? What's my, which one am I going to go hard or go easy on? And you know what? I can't blame anyone else. And so there is a bit of, there's some element of that. But anyway, I think the thing that gets me on this is that if you look at the Australian economy over a longer period of time, so let's say we say the last decade or 15 years, is we've basically been running this experiment for 15 years where we're saying, okay, we've got this economy that's highly dependent on commodity income and capex that goes into that. So there's two parts to that. Are we making money from oil or coal or whatever, and are we getting are we then taking taking that into government revenue and then recycling that back into the economy? So that's one part. But then the capex side is, are these companies out building new mines and things like that? So that's sort of two parts. Secondly, then is we're highly exposed to energy prices as well. And I'd say most of that is poor government policy in terms of how we've sort of opened ourselves up to energy prices. And so the RBA has no control over any of that. So these are all global prices they don't have control over. So that's the economy we've got. And then to complicate that, what we basically did was we had this weak demand for the start of this 15 years. And so aided by regulators, tax policy, government policy, we blew a world-leading housing bubble. And then as that sort of come off to keep that housing bubble propped up, now we've just like kept increasing immigration and more immigration. We'll keep those prices high and we'll keep rents. Now we've got this growth in rents that's sort of off, at least at the start of this, rents were like relatively stable, and now rents are sort of headed up at this massive rate as well. Okay, so that's the sort of our big picture. And what the RBA has effectively done over the time frame is it's used interest rates to trim a little bit what it can on the housing bubble while the government's sort of rowing in the opposite direction. But what it's really done is it's sent real wages backwards. So over the last decade or so, we've just had this crazy fall in real wages, and it's still going on. It's worse now than what it was at other times. So we're looking at inflation of 4+%, and we've got wage price inflation of 3, a bit over 3. And so real wages going backwards. So basically what we're saying is we've got a mixture of external forces and poor government policy driving these two major levers of our economy, energy and housing. And in order to make up for those policy errors and just the natural structure of Australian economy, we're going to constrain the consumers and try and drive that down low enough that that we get inflation back under control. Now, compounding that problem is because we're running high immigration, that keeps wages low anyway, and so we've already got a problem on that front. There's this massive AI boom going on, and the productivity gains of that certainly seem to be making a way into a broad number of companies who are at the cutting edge. And I think it will start flowing onto a lot of other companies down the train as well. So that's going to keep wages low at the same time. Again, out of the control of the RBA as well. And then we're raising rates. So we've got this mad immigration boom going on. We're raising rates so we can't build as much because people don't want to build because the interest rates are higher, and building companies going broke and all that type of stuff like that. So we're sort of, I feel like they're I don't want to say there's like an easy decision, they just should do X or they just should do Y, but I feel as if we're not even approaching the issue to say we have a structural problem. Here's the structural problem. We've voted in governments that have decided these are the policies we want to run with, and so you know what? We're going to crush real wages to try and get that under control. Or you could reverse some of those policies if you want. Your choice. Back to you, people. But if you keep voting in governments that are doing this is what we're going to do. We're going to crush your real wages. And so so I feel like that's where we are in Australia. What does that mean for Australian companies? Okay, so if you're a mining company, you sort of, in the end, you don't, what's going on in Australia doesn't actually matter. You're a global company, that's not really going to affect you. There are a number of companies within Australia who sort of fit in the same, pretty much into the same bucket. So if you're a Brambles, if you're a CSL, if you're a Cochlear, you're a global company. Yes, Australia is you might have a lot of your manufacturing here and stuff like that, but it's probably not really going to affect you if there's it might be good for you having lower wages in Australia. So so those companies are sort of unaffected, but the companies that are exposed to Australian economic conditions are probably, as you said, in a tough time for the next couple of years at least, while we raise interest rates to cater for government policy that's going in the wrong direction.
Yeah, absolutely. And the tough times, of course, also spills over to consumers too. So the CanStar calculation showed that if you look at a $600,000 loan mortgage over the next 12 months, it's now going to cost another $3,266, assuming there's no further rate rises. $1 million, it's more than $5,000. Those are material amounts for people already leveraged up. And again, I see it in my data that quite a few households are actually in difficulty. About half of those with a mortgage are actually struggling at the moment with cash flow. It's still pretty high, despite the rates were down, now going up again. But the renters, of course, even more so. So we've got this situation where it seems to me that we've got lots of companies, other than those big mining companies and some of those big internationally exposed companies, who are really struggling to make sense of what to do in Australia. Got a lot of households under significant pressure. And so the overall economic pie in Australia is really quite weird. It's very narrow. Of course, it's built on the housing and the holes, as we've always said. But the fascinating thing to me is that ahead, with lower growth, with lower potential expectations of wage rises, the government is now looking to try and find other additional taxes through this budget that's coming up. And they're going to make some tweaks at the margin to try and get more tax take. Remember that the bulk of government spending is now personal taxation rather than corporate taxation because of what's happened in the last 20, 30 years. So I'm struggling to sort of make sense. And I suppose the bottom line question for me, Australia was the lucky country. Have we lost that luck? Are we now going through a period of significant compression of real earnings over a long period of time? Yes. Is that going to change? Probably not. Are they going to dial back migration? No, because Chalmers has said it's going to be even higher in the budget, 15% higher or something. So you can see how these bear traps are being laid. And if I think of it from a purely investing economic perspective, Australia seems to me to be an outlier in terms of its prospective performance over the next few years, which means if you want to grow your superannuation or your investment portfolios, betting on Australia as the home for all your funds looks a bit wobbly.
Sure does. Yeah, we've for a couple of years now, we've been, well, a couple of years, I probably want to say most of most of the time we've been around, certainly the last 5 to 8 years or something like that. I think we've been very much overweight international versus Australia. And the international market has done way better than the Australian market. And I think there's pretty reasonable chance that that's going to go that's going to continue. Yeah, I think that I think we're probably 2 to 1 international versus Australia in terms of our in terms of the stocks within our portfolio, and we're certainly not looking to increase that. Sorry, not looking to rebalance that. We're sort of very much looking to keep the international exposure. So within Australia as well, I think I've shown some stuff here. I haven't got the chart handy, but it's, if you sort of say, okay, so if we look at resources as one sort of sector that's sort of a bit different and quite big in Australia versus elsewhere, it's 15% the market versus 15-20% versus almost nothing in as sort of global one. But then you sort of go, okay, what type of companies do you have? Do you have companies that are effectively rent seekers? So you're and you're providing services to other companies that are actually doing stuff. So if you're a bank, okay, what am I doing? Well, I'm lending money out to other companies that are actually doing things that are hopefully going to grow. So they're not the companies I want to be really big. I'd like to have the other companies out there doing really well that are actually doing new productive things rather than just transferring money around. Do you own property and you're renting it out? Well, you're not actually doing anything as you own that and you're renting it, but you're not actually sort of inputting back into the economy with that. Do you own a pipeline and you're basically renting it to people who want to transfer gas? Well, again, there's nothing sort of new and exciting you're putting into it. And so Australia's really big in all these property trust areas and pipelines and utilities and toll roads and all this stuff like that. And so if you go through and say, well, how much of that is the Australian stock market? And it's sort of 70% plus of the Australian stock market is either resources or basically these companies that are there to do things for other, theoretically more innovative companies are actually hopefully out there building, new ear devices or new biotech things or AI or services and things like that. And so whereas in most other countries, that ratio is, well under 20% that you get. And so you're sort of getting an ASX that's full of rent seekers, I suppose, is where I'm coming through from that. So at times they'll do really well. But there's plenty of times where you see the AI boom going on and these massive growth figures. That's not the type of without sort of getting the ear of government regulators and managing monopolies and things like that. That's not the same type of growth you're going to get for Australian companies.
Yeah, and I just want to highlight another point, that the regulatory environment in Australia has supported the rent seekers quite nicely over recent years. If you go through it industry by industry sector and you see how much tax support the government gives and how much regulatory control or not, they've had it pretty good. But it seems to me they're running out of runway now, and the ability to be able to grow those businesses in the current environment with households under significant pressure, with the costs of living continuing to rise for a lot longer, higher interest rates, would suggest that it's probably not the time to be loading up even more on that.
Yeah, well, and it's interesting. You sort of go, you pick some companies and you might go, well, okay, so you're a Coles or a Woolworths or something like, a JB Hi-Fi or something like that, and you're like, well, so people aren't spending as much, but maybe I've just jammed more people in, and I've got all the best spots, and so maybe there's an offset there is one part, but then secondly, these companies are really expensive, and so there's definitely they're expensive globally compared to competitors. So it's there's not heaps sort of that sort of goes back that I'd like to sort of that I think looks great for the Australian economy.
No, and that then takes us, well, okay, so if it's not the Australian economy, where then? Now, there was a period a few months ago where people were actually suggesting that investing in the US might not be that sensible. And in fact, if you look at the trajectory of this is actually the S&P 500, you can see there was a dip down between March and May. That was to do with the issues relating to the trade. And then, of course, we had another dip earlier in the this year, and that was basically the latest Middle East situation, right? But now it's all-time highs again. And in fact, if you go and look at the NASDAQ, well, even more so, all-time highs and looking very majestic, really. And so the question is this the full story, or what is really going on? And it's worth highlighting, I think, that not all stocks in the US are actually positive.
No, that's right. And the US has dominated it right at the top by a handful of companies that are just making extraordinary profits. And so a couple of things about that is one is the earnings growth, and I'll pop up an earnings growth chart, which is just showing these are the sort of forecast earnings growth. So each of these lines is where it started in a particular period and where it is now. Now it's so it might be a little bit small to see, but I'll go back and I'll sort of go, if I pick some of these, I don't know if you can see my mouth, to the middle of it, there's sort of like some brown lines that are sort of 2014, 2015, and that sort of started at 10% growth and then sort of fell down to zero. And so, whereas what we're looking at now is for 2026 is looking like almost 20% growth, and for 2027 is 17 and a half. Now, and they're both going up still. They're both sort of increasing at the end here. Now, to put that in perspective, the 20% this year, if that comes through, well, that's higher than any other year we've had, except for two, or any other year in the last, whatever it is, 20 odd years. The only two that were higher was 2018 when Trump did a massive tax cut. So basically cut the US corporate tax rate from 33 back to, well, actually there's various rates, but you get sort of blended rates. But yeah, that basically got you about 10 to 15% of that growth came from tax cuts alone, and then recovering from the pandemic. So really, we're looking at the next 2 years being basically the strongest growth years we've had, in the last 20 odd years in terms of earnings growth, if they come through. And so that's why when you look at markets, you're like, well, even though we're back to all-time highs on a valuation basis, we're not as high as we were earlier on this year, because the earnings keeps coming through. And so when you're looking, a valuation, you're looking at two things: what's this thing's worth, and then how much is it earning? And the earnings have gone up enough that even at current levels, the valuations are lower than what they were earlier on this year. And so you go, okay, so markets are a little bit expensive at the moment, sort of 80th percentile. But if it does 40% earnings growth over the next 2 years, well, all of a sudden they're going to look cheap. And so there's and then you got a question, okay, where's that earnings coming from? So, and where's it going to? So, which is there's times where you see this massive increase in the value of the stock market. For example, during the tech boom, we had this massive increase. And so I might jump. I've got a chart of capital expenditure. And so we're sort of running capital expenditure sort of growing at sort of 25%. And the last time we were back at these levels was December, coming out of the financial crisis. We sort of had that, but that was sort of like a makeup for poor prior years. And then back in the sort of tech boom. But the difference was in the tech boom, if I do a cash flow chart, the cash flows just weren't really growing that strong. It was all just, a lot of it was raising capital, whereas most of this is actually coming through from cash flow. So companies are actually, and it is again just a handful of companies at the top that are just so big they dominate it, is that they're making the cash. And rather than doing buybacks that they were doing a few years ago, I've got a buyback chart here somewhere as well, this is the level of dividends that they're paying, and then the level of buybacks that they're doing. And so if you look back a couple of years, the sort of dividends were sort of 1.5%, but then there was another 2% was coming out as a buyback, whereas now that those buybacks have really fallen down. And so basically your Googles and Metas and Amazons and everything like that, who was making all this money, not paying a dividend, just using it to buy back stock. Now they're not doing anywhere near as much buying back stock, but they're out there investing that money themselves into these data centers. And so, that's the economy we have. Is it sustainable? It all comes down to pretty much one man. It all comes down to look at the Straits of Hormuz blocked. and we end up in some sort of recession because we literally just can't get the oil at the right price, or do they remain even semi-open? I think is what markets are treating, and I think it's probably right that even if they might not be fully open, but if they're open enough that you don't end up in a crisis, then the boom that's going on in both this capex and also profit margins in terms of companies just I think at the moment it's where we're not hiring as many juniors, we're not hiring as many IT. Some of the bigger IT companies are laying off masses of staff, and finding their productivity is holding up despite that. That's and they're not competing them away. That's all ending up in margins. And so you're sort of having this weird thing where you're like, well, could you even end up with, say, $150 oil, really weak consumers around the world? You've basically got a recession going on, but actually corporate profits are fine. They're booming away because you get to lay off a somebody in your compliance department who you're paying $90,000 or $100,000 a year and replace them with a Chat GPT subscription for $20 a month. Or you're laying off somebody who's doing testing in your programming team, and you're paying 150, and now you don't need them anymore because the AI is doing it for you. And so there's definitely some. It's two speed. It's this K-shaped economy you keep hearing everyone talk about, and the question is, can you do enough in the Middle East to break it? Yes, you definitely can. And then the question is, will they? And that's where it's like, I don't know, and nobody knows. We've seen a deal. Well, it looked like in the last week or so, there's a deal done between Japan and Iran to maybe let some ships through. Now, I think one or two made it through. Will that turn into more? Won't it? Can China do a similar deal? I mean, because the big question for me is, if a Japanese ship sails into Saudi Arabia, so not going to Iran, so it goes in Saudi Arabia, an ally of the US, fills up with Saudi Arabian oil, sails back out and sails around to Japan, is the US going to blockade that? Now, maybe they're saying, oh, they shouldn't pay a toll, and Japan says, oh, no, we certainly haven't paid a toll. Maybe there's something else going on somewhere in the background that Iran wanted, or there's money somewhere ends up in Iranian bank accounts, or whatever it is that isn't classified as a toll, but for all intents and purposes is. Who knows? And then the question is, if Japan can do it, well, can China do it, and can India do it? And so there's that. If that's, I think the markets sort of are making the assumption that something will happen along those lines, that there'll be there's no grand deal that's going to get done, and the Iranians don't trust Trump and all that type of stuff like that. It's probably, there's no easy way out of this, but is there enough of a way out that you don't crash the world economy and then you let this AI boom do the rest? And that's what markets are betting on. I think it's a reasonable bet, but I also think at a certain price, and if the prices get too high, and the risks, and we're not on that path at the moment. Sometimes it looks like we are, sometimes it looks like we aren't. You need to be well aware that this whole thing can come unraveled.
Absolutely. And it's worth, I think, underscoring that when you talk about AI stocks, not all stocks are actually in the same category, right? So if you take Oracle, this is the Oracle chart, and you can see there that they reached a peak of 340, back then, and it's a long way down now. Compare that with Nvidia, which is touching, again, all-time highs, or indeed Apple, which is up there. And of course, Apple's now become effectively, I think, the second biggest capitalized company, I think, the last time I looked. Google, of course, now very much in vogue because of some of the things that they're doing and some of the chip deals that they're talking about. So you almost have to go through this, line by line and player by player if you want to actually understand the dynamics here, because not everything branded AI is actually necessarily equally valuable.
No, that's right. And there's a whole bunch of different sections of the value chain.
Yep.
So we're about to see a bunch of listings come out. OpenAI is going to list. There's a whole bunch of other smaller ones, but let's focus on OpenAI, because that's so these are the guys who have got particular they weren't a first mover. They were a sort of second mover after Google, but then they launched and they got themselves into the front. But now it looks like they've fallen behind, but they've still got a pretty big base, and they've still got a very good product. It looks as if they sort of made a bet in a particular direction that others more in terms of saying they were trying to go larger and larger, whereas the other ones decided, actually, what if we use multiple small ones instead, and that might end up with a better situation. But could they get the lead back? Sure. Are they making money? No, they're not making money, and they look like they're losing lots of money. And within all these, they're sort of sitting right at the end of this, and I look upon them and go, well, if they fell over tomorrow and weren't around anymore, is that going to ruin the market? It's going to hurt some stocks like Oracle and things like that who rely on them for contracts. But no, there's other players out there that are going to step into this. I do think that final sort of model and selling those models is going to be a tough market. That's sort of like your end game. Sitting right at the other end of the spectrum, you've got people who are providing services to these data centers that are being built. So whether it's companies out there that are digging the trenches and laying the cables and installing things, and NVIDIA sort of pretty much sits into that same bucket because there's later down the chain, but they've got the chips that are going into these. Now NVIDIA is interesting in itself in that it's got such dominant market share that you're sort of like, well, they just can't keep that market share forever. There's no way that that they won't find competitors, and Google's popping up with some stuff, and Amazon's got some things, some chips, and others are sort of out there trying to design. AMD or Intel are out trying to do things. So at some stage, there is a danger to it, but they've built themselves a pretty good moat. And look, if the market size doubles and they go from 95% market share to 65% market share, then they're probably still pretty good in terms of value. When you look at them from that perspective, it's really about how much bigger can this grow. Now, all of these guys are constrained at the moment as well. That's the other thing, is they're constrained in terms of can't build data centers fast enough and can't get the energy to do it. So some of these high energy prices are actually good for these guys insofar as they're prepared to pay way more for energy. And so if there's other people going, oh, I was going to build this thing and I'm not going to do it anymore, is that, oh, I'll take I'll take that allocation that you were going to have. If I can slot in there. There's lots of stories out there of people that had approvals to build various things, whether manufacturing processes or stuff like that, who are basically selling their approvals to some of the AI companies who need the energy, with the view that, oh well, I'm going to make more from selling it to them, and I'll just go and get another approval and I'll build my whatever it is in 3 years' time rather than now, and I'll make enough money from these guys paying me for the approvals that is worth it. And so so there's all these things slowing them down, but the net effect is it doesn't really harm them in a way. And in a way, it's good for some of these companies because if you're a Amazon or a Google or somebody who's got their data centers and you're selling the producing of it, if none of your competitors can build data centers fast enough and there's all this demand, well, I get to charge more for the ones I have. So not to say they don't all want to go out and build as fast as they can, because they all know, they're all looking at the numbers going, for every day that I don't build this data center, I'm losing literally millions of dollars because of the demand that's coming through. And so, there will be an end to this at some point. It's just, it can't be seen at the moment. And the question, I guess, 3 months ago, there was a lot of questions about, okay, they're spending all this money on CapEx. They say they've got all this demand. Is it actually going to come through? Well, it does seem the latest results sort of said, yeah, it does seem to be. And the fact that everyone's sort of constrained from building as much as they want is actually probably helping the situation, in that if they could build more, they could probably increase their CapEx by another 30%. These guys, and build, and then you just get into an overbuild situation sooner. But in a way, some of these constraints might actually be helping to prolong the life of this, in terms of not letting them overbuild as fast as they perhaps wanted to. So it is and a lot of these companies, they don't look horrendously expensive. Like you're sort of talking 25 to 30 times earnings for a lot of them, and that's that's sort of similar to a lot of Australian companies. A lot of the Aussie sort of Woolworths and things like that, you can sort of pick up on similar multiples. So with very different growth profiles.
And of course, we've also seen significant rises in South Korea, for example, with the Kospi there because of all of the tech-related stuff, and some of the Asian markets too. But I guess the big question is there a limit to the US tech's dominance as an absolute shield of the whole global economy? That's the real question, isn't it?
Yeah, that's right. And I don't think it's and who knows with that. Look, I don't think it's strong enough to if the Strait of Hormuz was properly shut for another 6 weeks or 12 weeks, then you're going to end up with massive oil prices and the whole thing coming unstuck. If that's at a zero ships going through, the question then comes down to, okay, let's say there's a third of the traffic that usually goes through there is getting through. Now, is that enough to crash the economy or not? And I think that's where the conjecture comes, because it goes, well, okay, so there's a 2/3 missing, but maybe some of that is being piped across, and some of that's being, got out in other ways, and then demand destruction and higher prices have managed to, and just people flying less and driving less and all that type of stuff like that. Maybe that compresses enough, and that's the world economy can handle that. I think losing the entire amount is probably more than the world economy can handle. But there's also the point that besides Australia's physically got problems getting the oil, we've got a lot more capability to pay for it than other countries as well. So there's some quite large countries. It might be that as much as it doesn't it might not come back to and might not seem fair, but somebody wants to drive their V8 down to the beach to go for a swim, and it's like, well, I've got to fill this up, and it's going to cost me $100 a tank or something like that. But I really want to drive my car around, so I will. And there's some Bangladeshi farmer who can't take his stuff to market because he literally can't afford the oil to and it's not worth the price of it and stuff like that. And so I do think you will find that there's there's an easy part of oil that comes out, which is the airline tickets go up, people don't fly as much. A lot of people just make decisions, small decisions that might be, I might just walk, or I might get I'll get a lift with somebody else, or a carpool, or whatever it is that sort of gets rid of an easy sort of 5% of demand. And then the hardest part sort of comes, or the harder part then comes as you sort of squeeze out the next part. And unfortunately, developing countries tend to bear the brunt of that. And then the question is, well, now if you start getting into the next phase where it really starts biting to bone, that's where you start getting, world economic problems. And so, I guess that's sort of my big picture view of where it's at.
Yeah, and that takes you to the question of demand destruction, doesn't it? Where is demand actually tailoring down? And in some cases, it will be countries can't afford to pay, can't afford, for example, to pay much more for the fertilizer that is available, and that could lead you into starvation and all of those horrible things.
Well, and also on that point, often a lot of the developing countries subsidize heavily fertilizers, and so they're effectively making the decision that we're just going to go into debt. So we might increase our fertilizer price a bit, but the fertilizer price might have doubled or tripled, and we're saying to farmers, hey, do you want to pay 20% more? And subsidizing, which is basically just this whole, okay, so governments are going into debt, households are copying it, and meanwhile there's three big sectors of the economy: the corporations, the households, and the government. So if households are doing bad and working down their savings, governments are out there borrowing money. Well, corporate sector is doing well, and that's the primary argument for if it doesn't fall in a hole, if it's just a bad slowdown for consumers, bad for governments. Maybe corporations do really well out of it.
Yes, that's a question muddling through. But I think you've touched on a really interesting point. If I look at the bond price, this is actually the 10-year US, and it's at 4.432%. And you can see there that it's a lot higher than it's been for quite some period of time. And I've got a bit of an issue insofar that I do think that bond prices are telling us something quite important. And in fact, if you wander around the place and it isn't just the US, the Japanese 10-year 2.5. Who'd have thought you'd be at 2.5 in Japan, right? I mean, that's pretty amazing. And of course, in Australia, we've also got similar issues with our 10-year now above 5%, 4.988, around 5%, and our 2-year is at 4.7%. Now, these significantly higher bond rates seem to me to be a very important signal, because what that is suggesting is that we are going to see the cost of money effectively going to be a lot higher. And that's going to change two things: the dynamics between stocks and bonds, firstly, and secondly, to what extent will corporations be able to actually raise the funds that they need, or indeed governments raise and then service the debts they need to be able to do the things they want to do. I mean, this is an important issue, isn't it?
Yeah, that's right. So this week I do stock meetings quite regularly, but we literally just got out of one, a couple of hours ago, going through all our stocks in our portfolios that have high debt loads and just double checking the thesis behind them. Can they afford the debt? What happens? How much demand destruction? All that type of stuff. Are they in industries that might suffer? Those types of things. So corporations are going to see higher interest rates. And so, I think it's well worth, if you've got a portfolio of stocks, have a look at the ones that do have high debts, because you just need to double check. If you're in an industry that's suffering on the demand front and you've got high debts, so Spirit Airlines in the US is a great example, is you can end up with the company going bankrupt. So that's one part. Secondly, as an investor, what have we done? Well, we got rid of a lot of bonds from our portfolios, earlier. But the other thing we did is flipped most of them into inflation-linked bonds. So I guess my take on this is that I think we're going to see higher inflation. We're going to see higher higher nominal interest rates, but we're going to see lower real interest rates. And so basically the gap between inflation and interest rates is going to shrink, because we're going to have a weak economy, and a weak economy with high inflation. And so central banks are going to want to keep interest rates above inflation, but they're not going to want to keep them too far above inflation, because they don't want to crash completely the economy. And we're going to be seeing, it's going to be relatively weak, so they don't want to make it that much worse. And so, so I think if you're looking for some safety within the bonds, well, if you're looking for safety, either cash is a great place for it. But then secondly is look to inflation-linked bonds, because I do think that's one area where inflation is going to be higher over the next little while.
Absolutely. And there are mechanisms to protect against inflation, but you need to actually be methodical about it rather than just, normal course of business. And it's interesting, the financial services sector, of course, has benefited hugely from this massive volatility. I mean, if you look at the volatility over the last few months, it's absolutely ginormous. And, JP Morgan came out with their results and they were actually quite strong, a little bit off their highs, but still saying, well, we made a big number from the trading profits. And I guess that's the point. With high volatility, you are going to see some additional creation of profitability from those trading banks that can do well, but there's also probably higher risks in there too.
Yeah, absolutely. So that's your danger now is, the straits are closed. We go into recessions. Companies start failing. That's where the danger comes from these. So banks are, banks have got the risks, and I think certainly within Australia as well. So we're looking, higher interest rates. Australian banks don't do anywhere near as much corporate lending as what they used to. Mostly, housing. And so, if there's any problems on that housing front, then, or miscalculations, I guess, in terms of RBA putting up rates too quickly, then there's obviously danger within those stocks. Banks. What we think of banks as very different to the rest of the economy is sort of separating them out as completely different, very leveraged entities, but it is that are going to do well a lot of the time, and then every now and again they're going to do quite poorly. And so it's just sort of a matter of trying to work out where you're sitting, and a lot of it comes down to as well, and we've spoken about in the past, is how profitable regulators let them get. And Australian regulators have shown that they will let the Aussie banks be very, very profitable. And no real signs of changing in terms of that. So they'll probably do well, but the danger is that you've got a sort of twofold danger when you're buying Australian banks. One is you do run into a recession or some sort of economic problems, which, as we spoke about at the start, is certainly looks certainly possible, if not probable. And then secondly is maybe sometime you'll actually get a regulator who says, well, why do Australian banks earn so much more than banks elsewhere? What maybe we shouldn't be paying. Maybe the people who are lending the money out shouldn't make as much, as we should leave more on the table for the households, borrowing, or more on the table for the companies that actually are doing, taking that money and doing something hopefully with it, rather than the banks themselves.
Don't hold your breath for that one.
No,
based on
right.
what I've seen over the last 25 to 30 years, right?
We can dream. We can dream.
Yeah, no, absolutely. And in fact, just to sort of give a bit of a context here, CBA, of course, off its highs, but still relatively strong. We had the ANZ results quite recently, and they were not as impressive under the hood because the margin compression was actually being seen there. But the one I've always been quite interested is the story around Macquarie, because of course Macquarie is a global player, not just a local player, and is doing pretty well at the moment. It's up to 236. It dropped back to 190-ish at one stage. But the big question, of course, for those who actually are reporting in Aussie dollars is the exchange rate. And it's interesting, of course, that even after the rate rise, well, we're at 71.67 cents to the US at the moment, and a little bit above 52 and a bit above the UK pence. That is, of course, not pounds, pence. And it's interesting to me that the exchange rate and the issue with regard to the way the exchange rate works with stocks in Australia is something to bear in mind. But it's not enough, is it, to cover the differential that we're seeing between what's happening in the performance of Australian stocks versus the US, for example?
No, it hasn't been. And this I guess it's we think of it as a good thing that you've got this basically this buffer where when things are going badly, typically you'll see the Aussie dollar fall, and that sort of gives you that offsets if you see global recession or global stock markets fall. Usually the Aussie dollar will fall as well, and you sort of get a bit of an offset within that. So that is helpful in terms of that. There's a key question around that whole US dollar, Australian dollar. I mean, the US does certainly look like they have less of an inflation problem than elsewhere, in that their energy prices are much better constrained. So yes, you had the tariffs that came on, but actually, services is the main part of most economies, and particularly developed economies. So, tariffs affected it, but it's at the margin. They're not as big. And, there was a lot of rediversions and things like that. So, the actual price effect is, it's basically looking at, and sorry, and the other thing was that's been an area that's typically had deflation anyway. And so you sort of got, potentially you've taken a lot of that out of that. So, so the US is sort of looking at less inflationary problems than say Australia. That was where we saw some of that push to the Aussie dollar sort of rose as like, well, Australian interest rates are going to be higher than US interest rates. But there is definitely a growth element to it as well. So on one side, people will go, yes, I'll go and I prefer to buy the currency with higher interest rates rather than the currency with lower interest rates. Yes, but they also don't want to buy the currency with higher interest rates that's got economic problems. So, and that's sort of typically what you might see in developing countries is, yes, they're running 15% interest rates. That's great, but they've got all these economic problems. They've got inflation of 12%, and they've got economic growth bouncing around from skyrocketing one year and crashing the next year and things like that. So people don't rush out and automatically buy currencies just because they're high. It is a growth versus inflation versus interest rate sort of argument on that front. And so within Australia, I think there's that. There's the Aussie dollar's high, but if for example the RBA decides, actually, you know what, we're just going to have to force the economy into recession in order to get these interest rates down, the Aussie dollar is going to come down a lot faster than even with higher interest rates that you might have.
Absolutely. And that's something else to bear in mind from an exchange rate risk into the future. I guess the other question, if you're sort of balancing different economies, and you touched on it, was the cost of energy, right? Energy costs in Australia are huge relative to many other countries. If you compare the average cost of energy in Australia, it's 2 or 3 times what it is in, say, the US. And in fact, it looks as though we're digging ourselves even a deeper hole as we go forward with regard to the energy policy, unfortunately. You may have seen, I don't know whether you saw this, let me just put that one in. The Australian Institute put this little advert out. This is actually when we had the visitor from Japan, the Prime Minister from Japan. We urge the Australian government to learn from Japan's energy and tax policies. Japan give gas taxes. Taxes gas, Australia gives gas away for free. Now, that's not quite the full story, but Australia needs to tax gas at 25% exports. Now, there's a really big, interesting, important question, but this energy conundrum is, I think, worth just spending a bit more time on.
So let me show you, let me bring up this chart because I want to talk about generation costs. Now, I want to highlight this by saying these are all averages. They're sort of, different markets, different prices have all different prices. And this is generation costs. So we'll talk a little bit more about the distribution and other things in a minute. But what it's showing, and this is just the last sort of 15 odd years, you sort of see that the first start with this yellow line of utility solar just coming crashing down from being way more expensive than all these other fuels to cheaper. You can see in 2022 we had the sort of first price round of as prices shot up in Europe that those prices took this real jump. We also saw that then the next phase, this utility plus solar, plus a battery to do some partial shifting. That's sort of this yellow dotted line. And that's been coming down, and we've actually crossed the line now where coal and gas are largely more expensive than putting in utility solar plus battery and partial shifting. And then the blue line is the utility solar plus full shifting or close to full shifting. So that you sort of basically you're running sort of a 24-hour system around that. And so you can see that's sort of reaching, not quite at the level, but it's certainly coming down. Now, one of the concerns around that whole, as we saw these prices really spike in Europe around gas prices and things like that, is that there's this mad rush for solar at that time. And so that actually meant that you can see even this at the bottom, that the price of solar actually took a pretty big jump into 2022 and 2023. And the price of solar plus batteries took a jump for a couple of years there. But that's actually resumed its downward spiral, and it looks like it's sort of, basically, yes, the trend is continuing and was always continuing. It was just that you've sort of you've had a one-off blip, but that final trend is still going on within that. Now, a lot of that is just producing more of it. As you produce more and more, when you produce 1,000 panels a week, you've got whatever costs they are. When you can produce 10,000 panels a week, now my costs come down dramatically. When I'm producing 100,000 panels a week, now they come dramatically again. There's just that whole just the volume, let alone the technological advances and all those things that are going on in the background as well. So basically at the moment, solar is so cheap, it doesn't matter. In terms of that, it's really this battery cost and the battery costs are coming down pretty dramatically. There's different technologies everywhere again in that, and so if we flip that to actually looking at breaking it out into sort of two different parts. One is, what's the cost of producing this? What's the levelized cost of just building whatever it is, and then what's the cost of the fuel that goes into it? So if you look at solar, it's costing say 3 cents $3 a kilowatt. And that's, your ongoing cost for fuel is nothing. So whereas if you look at coal, for example, at $100, you're going, okay, it's $4 for the cost, and then $3 for the fuel gives you sort of $7 overall. And then if you compare that to a partial battery that I've sort of circled, well, that's 8 cents for that. So coal at $100 a ton is cheaper than a solar plus a partial battery still. But when coal sort of hits $150 a ton, well, now it's more expensive. And if you sort of get to that sort of levels we saw in the Ukraine war, where you're $300 a ton, or natural gas is sort of $20 or $30 an MMBTU, well, now the cost of a solar plus battery is cheaper than the cost of fuel. Like it's getting to the stage where it's cheaper just to shut the whole thing down and install the renewables. So that's big picture where we're going in terms of the costs. Costs have been coming down. We've hit this point where it's now very much a turning point for batteries plus for battery plus solar. The other thing then is if you just said, okay, here's total electricity demand over the last sort of 20 or 25 years, and that's growing away. Let's just say it's going to grow at 3%, just to put some rough numbers in case over the next 25 years. And that's sort of a mixture of, big growth in terms of as we switch to more electric vehicles, big growth in terms of switching to um, more electrification of a lot of different things, uh, data centers growing. And then on the flip side, population growth has shrunk dramatically from the last 20 something years. And so, yeah, lower population growth, higher growth in some of these other things. So that's sort of our just our ballpark demand. And then you say, well, what's happening in terms of the solar panels is actually it's this idea of nonlinear relationships. They're quite difficult to see. And so when you're building a new coal-fired power plant, I built one today. If I build another one next year, I need to build, that's one more plant I need to build. If I build a factory to build solar panels, though, they're going to produce the same, producing 1 million solar panels. Okay, well, that's still producing 1 million solar panels next year and the year after and the year after. And so if we look at just the level of installations that have occurred, and you can just see this hockey stick growth in terms of installations. And then you go, we've also had actually installations are running well behind the actual solar panel production. So it can produce, I think it's like 30 or 40% more solar panels than what we can actually install at the moment. And you said, okay, well, let's just say that solar panels, they installation catches up with the production we have, and then instantly falls to 2% per annum. And so that's the only growth you get out of solar factories producing these solar installations. Well, if that's the case, given how much growth we've seen just in the last couple of years, literally the last 2 or 3 years in terms of the amount of solar panels that are being produced, we're going to get to 50% energy solar power, worldwide solar panel by 2040. So you're talking less than 15 years with just what we've built today. So if it expands at all, we're getting there faster in terms of that. And so I guess what I'm trying to get to with this is forget whether you think which one you think's coming or going. The argument now that you have to make if you don't think solar panels and batteries are going to get to a massive to take a huge part of the market is that you've got to bet that the current factories are actually going to shut down. We're going to lose installation capacity. We're going to lose production capacity from where we are today. And so we've probably done way more than what people think, I guess is where I'm getting to with this, is that push from Russia and the Ukraine, forcing all this extra production capacity to come online. Well, that's going to happen again. There's an even greater push coming through now. And so I think there's these relationships aren't linear. And that idea that we've seen this sort of, yes, it's been long, slow growth for 15 or 20 years, but now it's hockey sticking. It's hockey sticking. Don't sleep on how fast this is going to change. And we're going to see dramatic changes in these costs over the next sort of 10 years. So this energy sector is going to change. If you don't bet on the existing ones doing what they're doing, you're going to see change around that. And so we're investing a lot in this around these themes. But I guess the main thing to come out of the war is, to me, is whatever change we thought was going to happen already looked like it was happening at a faster pace than everyone realizes, and it's going to go even faster.
Yeah, very interesting. And I suppose the other side of it is you need the generation capacity, and I think the solar and battery together is providing much more resilience, right? So the trouble with the solar, it doesn't work at night. Right.
Yeah, exactly. So it needs solar plus battery. Yeah, absolutely. Yeah. So and I think there's I did just skip over that part, which was the generation part. So this is only 30-40% of the cost, depending upon where you are. Then your other 60% is your distribution and your whatever retail profits and things like that are being made. So that transmission is really important. So I showed those figures back there where solar plus batteries is just in front of coal. So if you've got coal in a spot where you've already built the transmission lines, then great, yeah, it'll be cheaper still than the solar. If you have to build the solar from from hundreds of kilometers away and ship it across. The thing is though, one of the key benefits of the solar is, yeah, you can generate it really close to where you need it, or certainly a lot of it, as we see with everyone with household solar. And so that means you might need less transmission. Like solar's got that extra benefit of like, well, if I can build rooftop solar or things like that and stick batteries, community batteries in or batteries in people's house, then that all of a sudden there's all this transmission I don't need. The fact that you're producing it all locally, storing it and putting it back out again means we don't need to ship it across. And so all of a sudden that puts it in front, even further in front. So not the utility solar, but the more local solar stuff. And so, yeah, big changes coming in this area. And I think there's a lot of people clinging to arguments that were true 5 years ago, or possibly true 5 years ago, or true 10 years ago, and those arguments just don't think they're still true just because they were 5 years ago or they were 10 years ago. It has been dramatic change in this area.
And I think the other add-on thought there is with the cost of oil rising a lot, and therefore gasoline and petrol, more people are going to go EV. More people will charge their EVs from the solar battery combination. And in fact, in some cases, the battery in the car can be actually part of the energy facility that you got when you're at home.
Yeah, absolutely. So, there's I haven't got the charts handy, but I think I popped them up last time just in terms of saying, the number of years to get a payback on your car. And ironically, the US actually looks better than a lot of the US, which has got the lowest penetration of EVs because of policy decisions and all that type of stuff like that, has actually got some of the shortest payback times. Some of the higher payback times are in places like Australia or Europe, where Europe they don't drive very much, and petrol prices are really high, but actually so are energy prices. So there's the US. I think there's a lot of pent up demand at some point in the US where all of a sudden it gets to the stage where it just flips to going, okay, now you're talking about a 1 year payback or a 2 year payback. And certainly on a lot of commercial vehicles, you're down to that phase where it's a 1 or 2 year payback where you're just like, well, the car cost me, $4,000 more to get it with a battery, but it saves me $2,500 or $3,000 a year. So now it just makes perfect sense to do it within some of those countries. So Australia's, depending upon how big your battery is and all that type of stuff, it's still talking 3-4 years. But if you want petrol prices that, you add another 50% to petrol prices, and all of a sudden those, brings you into the point where you're starting to make a much easier decision. And the battery technology is just getting better and better. And so, we're just seeing increases and improvements. And then the last one as well on that is driverless cars. So they are starting to go now. They're going exponential in the US, but at a very small rate at the moment. So I don't want to extrapolate too far out, but the real benefit of those is in terms of batteries and cars is that, people who are buying them aren't sitting there going, oh yeah, I need this battery to take me 500 kilometers. Otherwise I won't buy it. They can look at it and go, yeah, I'm driving around all the time. I'll take a small battery and I'll recharge, every few hours I'll just recharge. And so all of a sudden the battery, if you need a battery that can go 500 kilometers, well, it's 20% of that cost if I only need a battery that goes 100 kilometers. So I'm happy just to keep, charging throughout that time frame. And so, lots of different things on that front. I'm not, it's obviously nothing happening in Australia, but I think the exponential growth in terms of how the time Google or Waymo is taking between each city to roll out the next batch, and the number of trips it's doing each week is it's still a tiny drop in the overall bucket of transport, but it is starting to go exponential. And so, keep an eye on that as a big change as well, and a big switch to EVs. I think that'd really drive a switch across.
And I guess all that suggests to me that this whole idea of electricity becoming the center of future energy is almost but locked in now. I mean, the journey is still going to be wobbly, and we're still going to be reliant on oil for some time. But we are definitely heading in that direction. And as you said, like in the solar panels, well, we're making them, they'll be up in a few years' time. So it's almost inevitable now.
Yeah, I think we're locked in. And so, I mean, the question, there's probably some stuff you'll never get off. There'll be some stuff where it's like, oh no, this is actually the tool for it, forever. But, the idea of net zero is not that it's zero. It's not zero fossil fuel use. It's net zero. So it's like, yes, it's recognizing some industries are still going to have to do this. And I think as well, the other thing to keep in mind is that um, there's going to be more coal-fired power plants that get built over the next few years in countries like Vietnam or China or whatever it is. That's not because they want to buy Australian coal though. That's because they go, we've got our own coal. We don't want to keep buying oil from the Middle East because it's too dangerous or too fraught with supply chain problems and all that. So we don't want to replace a reliance on the Middle East with a reliance on Australia. We'll go to a reliance on something we know we can get locally. So there will be more of that built. But when you come back to that same thing again, China's the biggest, is taking up more renewable energy than anyone. And so yeah, I think that's.
And there's some very interesting debates going on in the chat there. I'm not going to put them all up because there's questions about waste and how biodegradable they are. Life cycles, all of those things, right?
Look, this issue. There's a great chart from somebody. I've got. Can I bring it up? I might be able to bring it up. Let me. There's a great chart out there which basically says, yeah, you look at the amount of waste there is, and there's waste. There's absolutely waste when you get rid of these solar panels, and then you look and you go, well, the waste is this much compared to the amount of coal waste we have just right now. And then you go, well, how much of it is versus the amount of waste in computers? And you're like, oh, solar panels are this, and computers are like 10 times already. Like we're already throwing away more computers than what we're throwing away solar panels. And so, yes, it's not a free lunch. There's downsides and all that type of stuff like that. But the waste from solar panels and the waste from these renewable energies is just the tiniest drop in the bucket versus all our existing technologies. And so, yeah, there's I can't find the chart easily, but I'll make sure I bring it for next time.
Yeah, no, bring it up next time. But it's interesting that there's discussion in the UK at the moment where some energy will effectively be free, particularly during the day when the solar panels are actually effective, because the marginal cost of producing it and shipping it is close to zero. So they're starting now to change some of the tariff structures to be able to reflect that new reality.
Yeah, so I think within that there's a what was that? Oh, I did find these charts too. Let me bring up these charts.
Okay.
Because that's okay, yeah. Because I do want to talk about that zero, because a lot of this is about batteries and arbitrage. So there is here we go. So
ready?
If I can pop that up big enough. So at the moment, the global cumulative waste from solar panels from 2016 to 2050 is looking like being somewhere between 54 million tons and 160 million tons. That sounds like a lot, but our e-waste at the moment is 10 times that. Our coal ash is, I don't know, I can't do the maths that easily on that one, but it's basically whatever it is, 455,000 tons versus 54. And so, average municipal waste is just, So yes, these things have waste. Yes, they don't have it's not all downside, but it's just that there's, it's chalk and cheese versus what we're doing at the moment. Just coal ash alone is the amount of waste we get from that. Yeah, so that was that. So the other one, So it's interesting. So this is this free part. So this and I think this is a limited time offer. So this is a you might get that. And all that's saying is, we've built too much solar, and we haven't built enough batteries for it. And as the batteries are coming down dramatically in price, and what's been really interesting in Australia now is that within Australia, the amount of money you can make from a gas-fired power plant is now much lower than what you used to be able to, because of all the batteries we're bringing on, is evening out the price spikes. So it used to be you'd go, it's whatever, the usual price is $50 a megawatt. All of a sudden it spikes to 1,000, and I turn on my solar my gas-fired power plant for an hour and take advantage of that, and then I turn it back off again. And so, and they'd make all this money from that. But because the batteries can switch on so much faster and have got that sort of spare capacity, those peaks and troughs are just getting less and less. And so I think there is a short term, yes, we've built too much solar and not enough batteries, and so there'll be offers of these free ones. But I think what we see is over the next 10 years at least, that'll go away because there'll be people out there saying, well, I'll take as much free energy as you want to give me because I'll fill up my battery with it and then I'll sell it back to you tonight.
Very interesting. And of course, the whole question of how you recycle and the e-waste, as Andrew says, is a real big issue. To what extent should it and could it be recycled? And that's part of the story too. So the whole of life idea, which is part of the circular economy, becomes ever more important, right?
Yeah, well, and that's a good argument for what do you call them? The taxes where you meant to tax everything up front for the cost of getting rid of it at the end. And so you go, okay, you've bought an apple. Okay, I'm not going to tax you on that because that's biodegradable and we'll take the cost of it. Oh, you bought an apple in a plastic bag. Okay, you got to pay extra on top of that. We'll charge you to get rid of the plastic bag and so effectively the idea is give people. Yes, stop people from having to pay for, to have your bins and all that type of stuff, but because you've charged them at the front, you've charged people on a consumption tax. But yeah, I don't know. Who knows?
Yeah, well, I'm afraid there's more and more usage taxes on the way through. Clip the ticket every now and again, I think is where it's going to be.
They'll put that charge on, but they'll also charge you to take your bins as well. That's where
exactly. So very interesting. Yes. And look, this energy story is really important, particularly in the context of what's happening around the Hormuz Straits and those sorts of things. But I think more broadly as well, and strategically, it's pretty important. But as we come towards the end of the show, Damien, one other issue I wanted to touch on briefly, gold. I think it's worth just reflecting on gold because, of course, gold was meant to be this hedge in uncertain times, right? It was meant to be the anchor, the thing that would always protect. Well, it's interesting. If you look at what happened to gold, we had this peak of 5,600. This is on the gold futures back in February, and we're now at sort of 4,500, give or take. And I guess it's an interesting observation about how important is gold in a portfolio, and is it doing what people thought it would do? What do you think?
Yeah, well, no, it's not doing what people thought it would do. On a short-term basis, I think if you zoomed out to a 20-year chart, you could probably make an argument that, oh, okay, well, uncertainty and all these things like that, and gold did help us on a 20-year chart, or a year-by-year chart. So I guess that's one side to it. The other one is, look, and I think this is very important at the moment, is in terms of gold, is trying to work out what countries are doing with their gold is probably the most important thing, insofar as if you've got countries who are needing to sell their gold reserves because they're not getting any money in from oil, and so they need to sell their gold, and maybe it's even just along with other currencies and their US treasuries and things like that, then that's making a difference. And so gold is not that big of a market overall versus a lot of other markets, and individual central bank decisions can really push this in one direction or another. And so I think there's if you go into a scenario where all of a sudden gold becomes more important because a whole bunch more countries need to try and get around the normal financial system, they're all going to try and use gold, then there's more of a bullish argument for it. If you get in a situation where all these countries need to liquidate their gold assets because they're running out of money elsewhere, then it's a negative story for gold. And so whatever the other effects in terms of safety and being an alternative currency effectively, and all these other factors, all these other reasons why you might want to buy gold, basically because other investors want to buy it, you need to keep in mind that those central banks are big enough that they'll push the price around, doing whatever they need to do in their country because of crises and other things going on.
Absolutely, and it's very important to understand that, right? Because the gold holdings and who's holding the gold is pretty critical. Some central banks have been buying up big as a hedge against the US dollar, and maybe as an alternative to the US dollar. And of course, the BRICS group are talking about that. It's worth highlighting, I think, that with regard to the Straits of Hormuz, I know that people were being asked to pay things like Bitcoin and cryptocurrencies rather than gold to be able to get through the Straits. So it is an interesting observation in terms of the evolution of finance. But at the end of the day, I think gold does have a place in a portfolio, but you need to understand what its place is. It is not the be-all and end-all of protecting your portfolio forever. And that's the critical point I think I'd want to make on that.
Yeah, that's right. And so it shouldn't be 50% of your portfolio. And the thing with gold is it's a speculative asset. I'm buying gold because I think somebody else will want to pay more for it. And that's an argument you make with gold. You make it with Bitcoin. You make it with, some of these other assets where you're like, okay, they don't actually do anything. I'm buying it because I think somebody else is gonna give me more for it. The difference with a stock, for example, that you're buying is, or better, even if you talk about a whole basket of stocks, you're buying, a market within it, is you're saying, well, I'm buying this and they are generating a yield for me in terms of the profits that they're making each year. Now, maybe we go into a situation where companies never make any profits anymore. That's a highly unlikely. They've shown over time companies will, and we're in capitalist societies. That's where we've sort of chosen to invest the money and to see this growth. And so that idea that even if they go down in price, I can sort of look and I can say, well, these things are actually generating money for me, and so over the long term, I can see why. If I get the big picture, why should I get say 8% a year from gold? Well, I think I'm going to get 8% a year because I think more people are going to want it next year, and more people are going to want it the year after, and nobody's going to find a way of producing it faster, and so therefore that's why. Whereas at least with stocks, I can say, well, why do I think I'm going to get 8%? Well, I'll tell you why. So I think companies generally are increasing their prices and will pick up on inflation. So I'm going to get some sort of inflation return. If I get 4 or 5% earnings growth, at least, so say I'm getting a 5% earnings growth and they're paying me a 3% dividend yield, then that gives me my 8%. Which is, of that, it's there's a real growth of say 2 or 3%. There's inflation, and there's a dividend yield that's being paid, and that's where we're ending up with this 8% type, somewhere between 7 and 10. I tell people over the longer term in stocks, but I can see why that's going to keep generating it for me. Whereas with gold, with Bitcoin, whatever it is, if you think you're going to get that ongoing return, your argument needs to be because I think other people are going to keep paying for it. And so, and therefore, and if you're right, you make out. But if it goes through, gold went through a period in the 1980s. I don't know if you've got that chart up there. If you had picked a spot, and this was, we had high inflation in the, through the 80s and 90s. You can pick a spot back there, and you said you bought gold, and it would have taken you 30 years to make your money back on it. So yeah, that 1980, you bought it $40. You were sitting there 30 years later, finally saying, I've got my money back. And so, and the 80s and the 90s had pretty decent inflation through most of that.
That's silver.
And so that's a long time not to protect you from inflation.
Sorry, that was silver. That's gold there, just to
that's gold.
Put the right chart up. Sorry, yeah. Yeah, but
yeah, same story.
Same story, and that is the point. And of course, that's not inflation adjusted, right?
No, that's right. Yeah.
Bear that in mind, folks. Remember, inflation was quite hot through some of those periods.
Yeah, that's right. So and I think that's the main one when people say, "Oh, gold will protect me from inflation." It's like, well, gold did protect you from inflation in the 70s, and then it didn't. It protected you from I think unexpected increases in inflation. Gold's quite good at protecting you from long bouts of inflation, and especially as central banks gradually try and work it down. That's what it's not good at doing, because if I can get, the real cost of holding gold is there's no yield on it. So I've got to buy it. I've got to expect somebody to pay more for it. When interest rates are 10%, well, I can get 10% in the bank, or I can get zero in gold. I need gold to go up by 10% every year just to keep up with what I can get on interest in the bank. And so, that's the point about the higher interest rates are, the tougher it is for gold to, it's got to keep coming up with that growth in order to do it.
Just look at term deposits at the moment. They are quite strong returns on term deposits at the moment. Now, I've got one last quick question from Cookie. Just back on the fertilizer shortage, and he's referring to Steve Keen. Now, Steve Keen's done some very good work in terms of highlighting the implications of the fertilizer shortages and the cycles of planting and all of those things. And, he's arguing that, well, we could see significant shortages and famines and things in some parts of the world, and food assurance is actually a question. So thoughts on that?
Yep, and we should touch on others. The other one is hydrogen, no, helium as well.
Helium. Yep.
Um,
Yep.
yeah. So look, I, I I don't want to downplay the fertilizer. I do think there's a reasonable chance that we're going to see, disruptions to world food supplies. Um, from an economic point of view, and I want to say this in from a humanitarian point of view, the sad thing with this is it falls on developing countries. Like I was talking about your fuel price issues, is that food is not that great of a cost in developed countries, and if the cost of your wheat doubles, then it's like, okay, when I look at a cost of bread, not sure, the cost of wheat is whatever 10 or 20% of that. So the cost of wheat's doubled. Maybe I've added 20% to the cost of my loaf of bread. Like, yeah, I don't want to pay it, but I can afford it. It's not really going to damage too many people in Western countries. In developing countries, that's where it really hits. And so I think there's a much better humanitarian argument there is than an economic argument within that. Now, maybe that leads to further problems. I mean, most of the Arab Spring sort of riots and things like that happened with some food problems. And so maybe you see a broadening of the amount of unrest in various sort of areas, and so that's an issue. But yeah, I think that's the sad thing from an economic point of view is it doesn't actually affect developed countries that much. And it is also worth noting that, look, food is certainly in the short term. Food's pretty good at it goes through stuff all the time where countries have droughts and can't produce, and other countries have gluts, and you sort of bounce around a lot and so the supply chains within food are a lot more malleable and a lot more resilient than supply chains in other areas. So that's one part. And that sort of brings you on to helium. So the interesting thing with helium is uh, the big guys doing the expensive stuff, so your TSMCs and all that, have put in a lot of helium recycling already. And so what's happening with and I think they're sort of getting 95%-ish of the helium is coming back. So the concerns we had around say Nvidia chips and stuff like that being sold out was like, oh, actually, that doesn't look like it's happening now. These guys are recycling 95% of it. Actually, that means the existing supply that you thought might last a month can now last 20 months. Okay, so we've cut out so we sort of cut out 30% of world supply. Some of that does look like it might still be getting out, but the question's not certainly way less than what we had before. The flip side, we've done that. Now, MRIs are being genuinely hit, so that's starting to fall off in terms of the number of MRIs. And you go, well, okay, that doesn't sound good, but if we could do 70% of the MRIs, is that going to be catastrophic for the world? Well, it's not going to be great, but I suspect there's probably, at the margin, there's probably some MRIs being done that probably don't need to be done, or there are other methods that can be done. So that will be disruptive. And then the other part is low end chips, and that's probably the one that's well worth watching. The one certainly that we've got our eye on in terms of supply chains is, um, there's some places talking about shortages in that end, and the issue is, if you're talking about building these low end chips, do I spend millions of dollars to put in the helium recycling in order to when the chips just aren't worth that much anyway? And so and to date they've been saying no. So there's potential supply chain issue there. And the other part is hard disk drives, which is mainly the high end ones. Now they can't do recycling because the helium's actually inside the disk drive. But what's been happening within those guys, and I don't know if you can easily bring up Western Digital as a share price.
Yeah,
I think it's WD, and their competitor. These things are rocketing because nobody can produce these things. So the existing ones they've got. So it's sort of like there's a shortage there's a shortage. All these data centers want these, and so the price they can sell them for is shooting up. But you know what? The data centers can afford to pay it, and so yeah, if you could have picked one stock to be buying during this, it's well, initially it's like, oh, these guys need helium, therefore, isn't it going to be a problem for them? Well, the share price has pretty much doubled since the start of the war, and as you can see from the demand they've seen from these. So at some point we'll come out the other end of these. These types of things are classic boom bust stocks where they will they'll all be up building factories and getting all this extra stuff. And at some point, those prices will all come crashing back down again, but not for a little while. And they're sort of all in that same boat as that. Okay, it's not, you're going to definitely be paying more for these hard disk drives, but it's a, it's certainly not catastrophic for the companies involved. And there's probably just going to be more of this part about, well, okay, so you can't build the data centers as fast as you wanted to. And if you wanted to get an upgrade for your computer, you're going to be paying more for it. And one more reason for more inflation behind that. But if it means that next time you buy a computer, you wanted to get you want to get 3 terabyte drive, well, bad luck, you're gonna have to do it with a 1 terabyte drive, And I think that's where there's probably a little bit more scope within that type of area to sort of move things around.
Well, it's very interesting because I had to replace an SSD drive on my computer recently. Micron has stopped producing the low-end SSD drives that used to be, so I managed to get one from old stock before it actually disappeared, but the price was a lot higher. So it is, I think, hitting some parts of the value chain already.
Yeah, and I think anyone who remembers, the whole, you got to pandemic and all of a sudden you're like, oh, I need a new webcam for home and whatever. And it's like, they don't do them. Well, they're sold out or whatever. I think we're probably going to go through a little bit of a phase of that. And so, yes, it's not good for the world economy, but in the end, it's a I don't know, it's a manageable problem. It's a first world problem. It seems to me that a lot of those issues. And so, yeah.
Yeah, I think you're absolutely right. Well, pretty much, I think we've come to the end of the show. I think my conclusion from this conversation, it's been very useful, Damien, is that, sure, the AI story is really important to understand, and it's certainly supporting markets, particularly in the US. There are a broader set of issues out there as well, particularly around the Straits of Hormuz. As for whether one will counterbalance the other, we don't know because it depends on what happens in the Middle East. But almost certainly, if you are highly leveraged into Australian investments in Australia, you're probably potentially missing out on opportunity. So it's worth just considering about rebalancing those portfolios and making sure that you're actually effectively getting the upside exposure from the AI revolution, which is predominantly but not exclusively US based.
Absolutely. And definitely you find, there's a couple of AI stocks you can get in Australia and a couple in Europe and things like that, but you're just getting if you want a broad-based exposure to it, then you need these US stocks because you can get, right across the entire spectrum of what's happening there.
Wonderful, Damien. Well, as always, I've really enjoyed the conversation. We've put links and things in below to what the world funds and Nucleus Wealth. If you'd like to get some specific thoughts about portfolio construction or indeed manage your portfolios, the whole idea of the platform, of course, is it gives people many options, Damien, isn't it?
Yeah, absolutely. So the whole idea, transparency and flexibility in terms of, you've got the stocks either that we're picking for you, or you can just get an index. If you just want to pay the cheap fees, have an index fund. But you get all the individual stocks and then you can decide to add stuff in and you can decide to take stuff out. So if you're looking at this going, you know what, I want extra nuclear power or I don't want any nuclear power, you can choose. Cut it in, drop it out. If you listen to this and you're like, oh, actually, I probably do need some extra AI because I don't have anywhere else in the portfolio, you can go, yep, give me a global portfolio, give me an extra AI exposure, or give me extra exposure to, electricity generators or gold stocks or silver stocks or whatever it is that you feel you'd like to have extra in your portfolio.
Flexibility, transparency, the two key points in that conversation. Damien, thank you so much. I'll look forward to getting you back next month and we'll have another wander around the markets and what's going on. I'm sure a lot will have changed by then. Again,
it'll all be resolved, I'm sure. Yes, that's right.
Okay. I'll take you off and finish the show. Take care.
Thanks.
Thank you. Cheers. There you go. I hope you found that informative, interesting. Damien's always great value and some real great insights there. Next week, it'll be me. I'll be talking about the latest from my modeling. You may have seen the coverage I got over the weekend in the News Corp papers on the mortgage stress stuff. There's a lot more to talk about there. So check that out. The dogs, of course, are here. They hardly moved at all. So that's walkie's time now. That'll be my next task. And I want to say thank you for spending some time with us this evening. Appreciate it. Please like, subscribe, share. Check out the recorded shows. I put them out every day, of course, and I'll be back live next Tuesday as well for my next show. This is Martin North from Digital Finance Click signing off. Take care. Have a good evening.